Financial risk refers to the potential for financial loss or uncertainty arising from various factors and events. It is an inherent part of any economic or financial activity and affects individuals, businesses, and even governments. Financial risk can arise from different sources and manifest in various forms. Here are some common types of financial risk. Market risk. Market risk refers to the potential losses that can occur due to changes in market conditions such as fluctuations in stock prices, interest rates, exchange rates, and commodity prices. It includes both systematic risk, related to overall market conditions. Credit risk. Credit risk is the risk that a borrower or client defaults on their debts or outstanding payments. With borrowed money, in addition to the loss of principal, additional factors such as loss of interest, increasing collection costs, etc., must be taken into account when establishing the extent of the credit risk. Financial analysts use yield spreads as a means to determine credit risk levels in a market. One of the simplest ways of mitigating credit risk is to run a credit check on a prospective client or borrower. Other means is to purchase insurance, hold assets as collateral, or have the debt guaranteed by a third party. Some methods corporations use to mitigate credit risk arising from non-payment of client dues is to request for advance payments, payment on delivery before handover of goods, or to not provide any lines of credit until a relationship has been established. Liquidity risk. Liquidity risk is the risk of not being able to buy or sell assets quickly and at a fair price. It can arise when there is a lack of market participants or when there is insufficient cash flow to meet financial obligations. Operational risk, as defined by the Basel II framework, is the risk of indirect or direct loss caused by failed or inadequate internal people, system, processes, or external events. It includes other risk types such as security risks, legal risks, fraud, environmental risks, and physical risks, major power failures, infrastructure shutdown, etc. Unlike other types of risk, operational risks are not revenue-driven, incurred knowingly, or capable of being completely eliminated. As long as people, processes, and systems remain imperfect and inefficient, the risk remains. However, in terms of financial risk management, operational risks can be managed to within acceptable levels of risk tolerance. This is done by determining the costs of proposed improvements against their benefits. Political and regulatory risk. These risks arise from changes in government policies, regulations, or geopolitical events that can have adverse effects on businesses and investments. Political instability, trade wars, and changes in tax policies are examples of such risks. Reputational risk. Reputational risk is also known as reputation risk, and it is the loss of social capital, market share, or financial capital arising from damage to an organization's reputation. Reputation risk is very difficult to predict or realize financially, as reputation is an intangible asset. It is, however, intrinsically tied to corporate trust and is the reason why reputation damage can hurt an organization financially. Criminal investigations into a company or its high-ranking executives, ethics violations. Lack of sustainability policies or issues related to safety and security of either product, customer, or personnel are all examples of what can damage an entity's reputation. The growth of technology and the influence of social media can now amplify minor issues on a global scale. This has led to boycotts as a form of consumer protest. In extreme cases, reputational risk can even lead to corporate bankruptcy. For this reason, more organizations are dedicating assets and resources to better manage their reputation. Systemic risk. Systemic risk refers to the risk of widespread disruption or collapse of the financial system, typically caused by interconnectedness and interdependencies among financial institutions and markets. It can have severe consequences for the overall economy. Foreign exchange risk. Foreign exchange risk is also known as currency risk, FX risk, or exchange rate risk. It is incurred when a financial transaction is made in a currency other than the operating currency, which is often the domestic currency, of a business. The risk arises as a result of unfavorable changes in the exchange rate between the transactional currency and operating currency. An aspect of foreign exchange risk is economic risk or forecast risk. The degree to which an organization's product or market value is affected by unexpected exchange rate fluctuations. Businesses whose trade heavily relies on the import and export of goods, or who have diversified into foreign markets are more susceptible to foreign exchange risk. Interest rate risk. Interest rate risk is the risk of losses or reduced profits resulting from changes in interest rates. It affects borrowers, lenders, and investors who hold fixed income securities or have variable interest rate loans. Rising interest rates can increase borrowing costs and reduce the value of existing bonds, while falling rates can impact investment returns. It is important to note that different individuals and organizations have varying risk tolerances and risk management strategies. Financial risk can be managed through various techniques, including diversification, hedging, insurance, risk assessment, and contingency planning. I hope you like this video very much. So subscribe to our channel to get more updates like this.